What is up, everybody? This is Matt Cox back with another episode of the Saucetown Investor Podcast. This is a special one. We've got a guest for the first time in our illustrious 3-week history of the pod. But I know a lot of you guys, a lot of our listeners are investors in Oregon, and there was a piece in the Portland in particular, the Portland paper of record, the Oregonian this week, that went a little bit viral, went a little wild on social media and in the news. The kind of headline that everybody caught was an economist by the name of Mike Wilkerson had a quote stating that Portland may be in a doom loop or is headed toward an economic doom loop. So I almost recorded this episode on my own, but then I thought about it and I go, hey, I think I know a guy who's actually more qualified to talk about this than I am. And he actually posted about it. There was a lot of traffic under your comments on that one. But our first guest in Saucetown Investor Podcast history, this guy is well known in the industry. He's flipped over 100 houses. Paid off $100 million in debt. We might have to talk about that a little bit. But he's done it all. He's been an investor, an appraiser, landlord. He owns a property management company, a brokerage. You know him from the Deal Junkies podcast. He's been on Bigger Pockets. He's done it all over the past 20 plus years. I am joined by Macro Mike Nuss. Mike, what is going on, man?
That's funny. You dropped in the macro. That's awesome. I'm great, man. Thanks for asking. Thanks for having me. I appreciate it. I'm excited to talk about our pending urban doom loop.
Yes, I'm excited to get into it. But real quick, remind me, you are a Salem resident now. You've been there for how many years?
Well, I moved back down here 2 years ago. So I grew up here, moved away right out of high school, started working in Portland during high school, and then moved to Portland right after high school. And then I just moved back a couple years ago.
Very good. And you're right there near Fairmont Hill where I grew up, right?
Yeah, just down the street.
Love it.
Walk by your old house all the time.
Best neighborhood in the state of Oregon. I might be a little biased on that.
Salem for sure. State of Oregon might be pushing a little bit.
It's pushing it for sure. Yeah. I will say Salem though. Okay, so let's hop in on this. Just to take us high level, just not particular to Portland, just from an economic standpoint for our listeners, just briefly explain what the concept of an economic doom loop is.
I don't know. No, the concept of an economic doom loop is that you don't have a cycle, right? So if you think about the best way to explain it is to talk about the spectrum. So one end of the economic spectrum from a metropolitan standpoint is a doom loop where incomes go down, taxes go down, services go down, which then people move out, income goes even more down, taxes go more down, services go down. And then you just have this spiral of down, 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 negative, negative, negative. The other end of the spectrum, you have just amazing cost of living, in migration, population growth, the other extreme of that spectrum. And so a cycle, just you move towards one end until you get too close to it, and then you move back until you get too close to that, and then you move back. And that's just how economics work, is we have these cycles, and that's just the momentum that we have. So at a macro level, if you think big term over the past 20, 30 years, that's what Portland has been. We've been on one side of that spectrum, and we've had lots of migration and lots of income growth, and more specifically upper incomes, our households formed in those upper income thresholds has increased significantly. So post-pandemic, that pattern has changed. And what's more interesting is when you look at our surrounding communities, it's quite obvious that some of those incomes have just moved away from the Multnomah County community into the surrounding communities. So when we talk about Portland, we're talking about a tri-county area, Multnomah County, Washington County, and Clackamas County. And then right across the river in Washington, we have Clark County. And so Portland is not like most major metropolitan areas where our downtown struggled during COVID times, and then that started affecting office occupancy and retail, and then that creates that downward spiral. What's special about Portland is we became the national media branding as far as this is what poor leadership looks like. And so you combine all those sort of things and you can get a negative mindset around that. So, and then the term doom loop, 4-page report that has about 5 or 6 graphs on it. And then the last statement is purely leadership needs to turn around and create more economic opportunities, or else we're going to face what other regions have faced, which is the dreaded doom loop. So the thought process of a doom loop is just that we don't have a cycle, that we don't bounce back and there's no change, and then we're just going down, 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 and down. And when you look at these handful of graphs that you point to, you can kind of make a case that that is where we're headed.
Really? So you're of the opinion that there is a case to be made that Portland is headed toward a doom loop? You think that's say more.
Yeah. Well, so first, let's back up. Let's get back up. Like when it comes to me in economics, the comment I say is statistics are bullshit. So that's the first thing that we need to understand and put in context. So I kind of started putting in context when we talked about the spectrum, which is if you look at the macro level and you back up, we've been on one side of the spectrum for a little while. So when I say we've had about 4 or 5 graphs, and you can look at the data and paint a case, if you focus in on the past few years, our population has gone down. So that's essentially the large screenshot, macro shot on the report is our population has gone down. We've lost 9,600 jobs in the finance service sector. So we haven't recovered our jobs. And more importantly, if you look at the average income of people moving into Portland right now, the average income is $75,000. You look at Clark County, the average income people moving in is $105,000. And so if you compare our statistics over the past 3 years to Washington County, Clackamas County, and Clark County, then you can paint a picture. But what we're not going over in here, and what, The Economist is, there's a couple videos that are going around. He's actually interviewed, and if you actually listen to it, it's the main one's a 9-minute long video, 7 minutes that focuses on this last term, the last sentence that uses doom loop. That's literally the last 2 words of the report is doom loop. And then in the last minute and a half of that main video, he says, well, here are the silver linings, right? So Portland still is moving people. So we're still, we still have an in-migration projected population to go up. People still want to move here. The question is, can we keep people here? And so the biggest damning stat of all of that was one statistic says for real estate, we are now 80th out of 81 cities. So a survey of here's 81 cities. If you're surveying commercial real estate, so this is a Urban Land Institute survey, Emerging Real Estate Trends, which is a really good survey nationwide for commercial real estate, but it's based on investment capital, right? So this is the stat of, in the commercial world, where does investment capital want to go? Out of 81 cities, Portland when I started reading this report, I think was 2016, 2017. At one point, we were number 1. We went from number 12 to number 2. Seattle was number 1. We were leading emerging trends as far as this is where capital wanted to be, which made sense. We had the most cranes in the air. We're building apartment buildings. We're a low cap rate environment. And for the first time, we were on the map for institutional capital. And so institutional capital was flowing into our region. And that's what that report reflects. So last year we were 50 out of 81 cities. This year we went to 80. And so in that interview, the concern is, if you actually look at the graphs that point this concern, which is our population decline, job growth decline, the graphs were worse 3 years ago. So it's the last 3 years. All 3 counties are negative. Portland, and we all improve. So the negative report isn't as negative. So the stats are actually improving. So again, you can look at it and look back and say, well, the trend was there, just like lots of metro areas, and the trend is improving. And the Economist in his interview exactly said, I thought we would have done better on that report. Instead of being at 50, why did we drop to 80? Well, again, understand what is that report. It's institutional capital. Where do you want to go? institutional capital doesn't want to come to Portland right now. Why would capital want to come to Portland? Institutional capital comes into big projects. Where are those? Those are in the urban core. Those are in the parts of Portland that are struggling the most. Not to mention, we're on the back end of a construction boom cycle. Our stats look better going forward, but we've seen flat rents, declining rents. So like on our podcast, the Deal Junkies, we talk about this a lot. Like Salem, an hour south of Portland right now, it's tough because it's been overbuilt. We've had a lot of new construction, so vacancy rates are up, occupancy rates are down, rents are flat. It's harder to lease up. Portland went through that cycle during COVID because we were dropping a ton of inventory. And so not only do you have, which was kind of good because you're dropping inventory when a lot of people, it was kind of absorbed during that period of time. But now we're on the back end of that cycle where we don't have a lot of construction in the pipeline for new apartments. So from an investment capital standpoint, the other thing you need to think about is money is just puckered to begin with. So not only is cash on the sidelines a historic amount of cash on the sidelines, but it's very nervous cash that's on the sidelines. And so where you're going to get even more conservative and you're going to be even more concerned about your regulatory threats, all the other threats against your capital. So are you going to want to go to Portland from an investment standpoint? No. So I think we're pointing to one of those statistics that when you actually look at it, it's not a nothing burger, but when you frame it into the actual context of how you look at it, it's expected. The question ahead is, are we in a doom loop? So are we at a point where we're going to be losing so much income that our services are going to degrade, and then now we can't attract people? And, there was one of the graphs or comments was a survey, 7 out of 10 of the survey respondents don't feel that we provide the services for the amount that we tax. And I lived in Portland for a long time. I can't disagree, as far as what we're getting for what we're taxed. And I would be lying if I said I didn't think about it. The question is this a trend? Is this going to continue, or is it going to change? Now, I think the way that you look at it is you can frame it, compare it to other cities, right? So if you think of the West Coast, you think of like Seattle or San Francisco, our closest metropolitan competition. What's unique about us is we have another state, Clark County, 15 minutes away. There is no income tax. They have sales tax, but we don't have sales tax. So you have this, you can literally migrate 15 minutes away, keep a lot of your lifestyle, but change your cost of living. And people have chosen to do that. And Vancouver's invested a lot of money into their downtown, their downtown waterfront, made significant improvements over a period of time. And now we're at a point where the cycle is changing to where if you look at it, Vancouver feels, at least from an investment real estate standpoint, like it's as expensive as Portland. And that used to not be the case, right? So Portland was the more expensive place. Vancouver was cheaper. So as Vancouver becomes more expensive and then relatively Portland looks cheaper, decisions start to make and capital starts to flow differently. And that's how the flow out of downtown happens. So yeah, we had a leadership policy that made downtown look physically very, very bad for a period of time. And during that period of time, lease rates in Lake Oswego and Tigard and Beaverton and Washington County, they were very attractive to businesses. And so we had all these businesses leave downtown and take up cheaper leases. Problem with commercial scenarios is it takes 5 to 10 years for these leases, right? So you're talking longer leases and businesses up and move. And so it's going to take a while for those businesses to move back. So in that period of time, you need new businesses to move in. So what does that cycle look like from a downtown standpoint? I think the biggest the thing to think about though is submarkets. Our neighborhoods of Portland, like our urban core Portland, are significantly different than downtown. So downtown really has its own cycle that it's going to happen from an economic standpoint.
And the part people forget about Portland too, if you don't live here, or if you don't, I say here where I used to live, is if you're watching it, and I run into this in New York all the time, like Portland does have I think it's fair to say Portland does have a branding problem on a national scale. That's what's reflected in that survey, right? It's just a survey. Portland's 80th out of 81. It's basically, there's data points that are numerical, but that data being 80th out of 81 in that ranking, it's basically just sentiment. It comes down to a branding problem, and a lot of people look at what you see on the news. If you live in New York or wherever, is you see downtown Portland, and you think that's the city, right? And Portland, if you live there, obviously has a ton of cool neighborhoods. In fact, pre-COVID, at any time, like downtown Portland has never been the quote unquote cool place to live, really. It used to be better. It used to have more economic activity, but that's never been the spot that was like the most strived for as far as, multifamily or for people to live in, correct?
Yeah. You only really have a couple districts in downtown. You have the Pearl District, which is mostly condos. You have South
Which
Park.
I don't count as downtown. Like,
Yeah,
I
correct.
mean,
Yeah.
like south of there. Yeah.
And then, but the urban core, and the other part is economics trails what's happening in Main Street, right? So your economic reports, for example, like one of these reports was 2023. We're pointing to data in 2023. We're in 2025, right? So, and the trend has been getting better. So if we can see that the trend is getting better and the data isn't as bad, yet we're talking about old data, what is life like right now in 2025? And Portland, downtown Portland, we've completely changed our form of government. We've gotten rid of our old mayor. We've gotten rid of most of city council. We've had a significant change.
So,
in
Mike,
leadership.
say more about that, because I know you've
Mhm.
you've been involved in committees throughout the years, and so what is changing politically in Portland right now?
Yeah, it's best to go look back the past 10 years. So we had an old mayor, Charlie Hales. So it kind of started in 2014 is when we got rid of our camping ban downtown. So that's really where it started. Is our housing crisis was labeled a housing crisis, I think, in 2016. In 2014 is when we got rid of the camping ban. And so that's when our homeless activity really started to pick up, and when you started to kind of see it on the streets. And so when you started to see it on the streets, then voters start changing, right? We're in a housing crisis. Rents are skyrocketing, prices are skyrocketing. And in 2014, we were the magnet for outside capital, right? The way the cycle worked is local developers started buying land in 2012. Entitling projects started coming out of the ground in 2013, and then projects started landing in 2014, 2015. And the projects that were landing ridiculously profitable for the local developers because they got the land the cheapest it was, the permitting was the fastest and the cheapest, labor was the cheapest. And then they started selling those projects to regional developers as they're buying more land. And then the regional developers got national capital as well. So you saw this flow of capital from 2012 to 2019 just ratchet up, not only in the pace of capital coming into Portland, but the avatar of that capital. Are we looking at 1 to 2 year rates, like your local developer time frames, or are we looking at 10, 20, 30, 100-year time frames? And so then that changes the type of projects. And so in 2014, the mayor at the time gets rid of the camping ban, and then housing crisis comes out. So in 2017, 2018, and 2019, that's when we had a huge political shift here. And so we started as a voting base, voting in city councilors that had no track record of knowing anything about leadership or economics. We voted in a bookstore owner who was on the brink of solvency, who ran on a tenants' right campaign.
Only
And
bookstore owner I'd vote in is whoever owns Pals. That's it.
yeah,
Pals. I'm
she
not
didn't
voting for
own
them.
Pals. So she had one employee, and then essentially ran on a landlord hate platform, and then immediately started taking shape. So they were voted in November. In January, they dropped a national precedent mandatory relocation policy from a residential landlord standpoint. So in February of 2018. It was either 2017. So she was elected in 2016, I think. February 2017, I went to city council and testified. And so since then, yeah, I was on a lot of committees. And so I've worked with the new leadership. I saw the new leadership come in. I saw how they communicated with landlords, both on security deposit stakeholder meetings and screening criteria stakeholder committee meetings. And then ultimately I was turned into a commissioner on the Rental Services Commission. So I've seen every change. So we've made national precedent changes on the policies that we've created. And I was behind the scenes watching all that happen. And it was really just leadership. We haven't had any good leadership. Our last mayor, who I can't remember his name.
Ted Wheeler?
Ted Wheeler. Yeah. It was a very just talk out the side of your mouth type scenario, right? You see them in a room and you listen to the way that these leaders would talk. They don't know anything about housing. They really don't know anything about economics. They're just told lots of things, and then they meander to their constituents.
Well, it's just populism, right? There's more tenants than there are landlords, so I'm just going to do the thing that the tenants want, and I'm going to demonize the quote unquote wealthy landlords, because there's this idea that every landlord must be a billionaire when I forget, I don't have the exact number in front of me, but there was a stat that was like, I'm going to butcher the numbers, but it was like 60% of landlords own like one or two houses or something like that. They're usually people that put money away. It's like a retirement plan. They buy 1 to 2 rentals, and they're not the big bad landlord, and a year-long eviction process can put them out of business.
Yeah, and that's so the mom and pop landlord, that was the kind of the voice that I was supposed to bring to those stakeholder committees at Rental Services Commission. So I 100% understand. Like, I have a property management company, so doing property management in Oregon and Portland isn't problematic for me. Because I'm a professional. I'm supposed to acquire real estate. I need to know those laws. And not only that is, having the property management company is what facilitates all that. But if you're a small mom and pop and you're leasing a unit, 1 or 2 units every 3 or 4 years, it's nearly impossible to keep up. And so costs have increased. And so the report is correct that the stress is there. I flip a lot of houses. Well, I can make no money and have a $50,000 cat tax. It's a gross receipts tax. And so we're not in a great industry where we do have exposure to those things, and other businesses do as well. And so you do need to there is reality that there are trade-offs. And that's what economics is economics is just trade-offs. And that's how those cycles happen, which is, well, Vancouver looks pretty good right now. We're going to go to Vancouver to live in. Southwest Meadows Road, which is just the ugliest office row in all of Metro Portland. Well, it's really cheap. This looks like a great place to house your business, right? And so you make these economic decisions, and that's what people have been doing, is they've been voting with their pocketbook. But the other thing is that's happened at the leadership level as well. So we've re-voted in all brand new leadership, and that change happened the past 2 voting cycles. And so the bookstore owner, she didn't get reelected. And then after her, one of the leaders was a very defund the police. She didn't get reelected. And not only did they not get reelected, they got their ass whooped on reelection. And so, when the bookstore owner got elected, I remember talking, because I'm in people's living rooms. That's what I do for a living, is negotiate real estate. And so, I'm in these ultra wealthy liberal mindset people that voted for her, and I'm in their living room, and they're like, she won't even take a meeting with me. And she immediately turned her back on the neighborhood associations, because that represents the rich white people, and those were the people that voted her in, and she turned her back to them immediately. So before, like, 1 year into her, she already lost that vote. I've communicated with these people that fundraise for these leaders, and immediately they switch. And so we saw that quickly on leadership change, and that's continued for the past 2 election cycles. And so then what we've seen physically is, well, those changes have happened from a policy standpoint. So now we've re-implemented it. So camping on the sidewalk is a crime again. One of the things that we did at the state level during COVID was we decriminalized hard drugs. Well, we recriminalized hard drugs now. So some of those policy decisions that we made that led to COVID and the zombie streets that we created, we've already reversed we've pivoted from those standpoints. And so when I look at it as someone who's been here for 30 years, and that's kind of the background. My background in Portland is I'm not an economist. I'm an investor. So I look at it as an investment mindset. I was an appraiser. I've driven the streets of Portland for 30 years, and I know exactly how our economics have shaped every part of our metropolitan area and why money has gone these directions and why employers have gone these directions and physically why we've built out in these locations. So I can see how the pulse of Portland has shaped what it is. And it is coming back into the neighborhoods. Like the vibrancy of the neighborhoods has come back. The livability of the neighborhoods has come back. And so the question is downtown hasn't. Downtown won't for a while. When we talk about real estate, that economic cycle is long. It is ugly. You do not want to be a condo owner downtown. Like there are problems downtown.
There's condos down there. I'll look at individual condos sometimes that are selling at literally selling at like 2002 prices if it's smack in the middle of downtown there. It's insane. Even stuff in the Pearl,
But also at the same time, we have the only ever 5-star, 26-story Hilton, it's a hotel and condos, and we're selling at record condo prices. Now they're sitting. I think only one of those penthouses is sold or something like that. But you have, so what's interesting, like that development in itself, the 5-star project that, I can't even remember what it is, what hotel brand it is.
You're not talking about the Ritz down there.
The Ritz-Carlton.
Oh, the Ritz, yeah.
The Ritz-Carlton, right? So a 5-star Ritz-Carlton started going in right before COVID, and they finished the project. So you're talking significant capital stack, finishing the project, and restaurant's amazing. They are selling some of those units, but
they converted. They changed the business plan, right? It was going to be just a hotel, and they converted a bunch of them to condos they sold, right? Or do I have that wrong?
It was always that stack. So it's a hotel.
Oh, they were okay. Got it.
It's always been designed for that stack. So. So it is interesting. The question is businesses have left downtown. There is no doubt about that. How much of a drag will that be on the inner Portland neighborhoods? Because that's the real appeal to Portland. So, the 2 miles east into northeast and southeast, 82 blocks, 82nd Avenue. It's kind of the cutoff. Once you get past that, you're really just blue collar Portland, and it's more about cost of living, proximity to jobs. It's more workforce housing. You go west of that, that's where it's more historic, it's more romantic. That's where values have significant ranges of value. You go east of 82nd, like I've got a flip on the market right now. I hope I can freaking sell it. It's on the market at 500. The county's taxing it at 600. Looks like a freaking steal, and they can't sell it. If I were 40 blocks west, it would be 700 grand, right? So right. That's kind of the dynamic shift that we have. Is we do have a workforce housing, and then we have a more higher income area, and so those areas are coming back. The question is how much will jobs moving out and incomes moving out affect those neighborhoods? So supply levels aren't out of whack, values aren't declining. Overall, the real estate market isn't great, but it's not.
So let me present an idea, a thesis to you, and we've talked a little bit offline about this. But as it goes for real estate investors in Portland, in the multifamily space, so in economics, you'll hear the term distressed asset thrown around, and a distressed it could be any asset, a stock, a piece of real estate, or you can even use it to kind of talk about a market, which is what I'm going to do here. And oftentimes a distressed asset can go one of two ways. It can keep plummeting, call it like catching a falling knife, or it might just be a distressed asset because there was some bad news. There was a bad headline, or they hired a bad CEO, or in this a mayor maybe. In this case, the idea is that it's a fixable problem. So I'm taking the side that Portland basically is the latter. It's had a branding issue for a while. The other side of if you're going to take the other side, you'd be saying that it's going to turn to Detroit or something like that. Like that is a doom cycle, and I'm certainly not taking that side. Portland is still it's a cool coastal city. It's not going to be Seattle or San Francisco ever. It doesn't have that amount of big business in it. But my take on this, and you know more about it than I do, but it has been building has slowed the last few years. Vacancy levels are very low. But institutional capital isn't buying it. Like you said, that institutional capital isn't flowing in right now, which is in turn, it's supply and demand. There's less capital to go after that supply. And I think it's the time to buy right now. The time you don't want to buy is when everybody is piling in. I mean, you look at like any insert market in Florida or like in Austin, Texas, the past few years, when everybody's buying, you're going to overpay for it. So my kind of thesis on this is right now is the time. If you're an investor like us, we're not institutional capital. We understand we're on the ground. We've done business here for years. Now, I think now is the time to pile in. And in a few years, when institutional capital comes back, you can see the market rip. I don't know. What are your thoughts?
Yeah, I agree with parts. I disagree with parts. I'll talk about getting in front of capital last because I do like my story makes a lot of sense to what you're saying. And I'd agree with that. There are, going first with your distressed assets, you can have, so like downtown Portland, I was in escrow to buy a building in downtown Portland this year, 10-story tower, $5 million, ridiculously good price. They had just put $26 million into it. The building's still vacant. We didn't buy it because it was the bank owned it. They wouldn't give us an extension. They ultimately sold it to the neighbor for $3 million. The whole block is vacant. Like even with the $26 million renovation, you can start moving people in right away. It's vacant. You can't fix a dead economic cycle. And that is what downtown is. It's a dead economic cycle. And so when I say downtown, there's a long cycle it has to go through. Businesses need to finish moving out before businesses are going to move in. Now, the first wave of businesses moving out, they're moving out of the region. They're going to the other employment scenarios. The next businesses move out, they're just going to go move into the nicest space downtown at ridiculously cheap rates. So now you need to go fill up. We've had a ton of new A-class construction, both in apartments and office and retail. And so all the A-class needs to get filled up. And then the B-class is going to get filled up. But the reality is downtown Portland's going to have a lot of old, historic C-class buildings that have zero occupancy. You can't sell them. There's a building, one of my group chats recently, this is an on-market building. They just put $2 million into it. It's on the market for $1.5 million. They can't sell it. $1.5 million for a historic, something that would be 5 years ago. Wow, that would be amazing to have that in our portfolio. Right. I remember we bought 2017. We bought a beautiful 3-story Victorian 9-unit apartment complex in downtown Portland. It's like the vein of the existence now because of the management, because it's like during COVID, the some of the worst homeless camps were across the street.
When you say downtown on this one, where is this one located?
In downtown, like 12th and Columbia.
Okay, so gotcha.
Downtown.
Yeah.
And so it's just, so in that building, it sucks. We have to, like our lease up strategy, we have to use nonprofits, and it's people that are coming off the homeless, right? It's completely different. Turnover costs are really high. Vacancy is high for that sector. Now, if that building were 1.5 miles away on the other side of the river, we don't necessarily have those problems. And I say necessarily because we still do have pockets. I've got an 8-unit building in a great part of walkable, trendy North Williams, but it's also close to Unthink Park, which is where the homeless activity is, and it's next to a children's community center. So you have a lot of vacant land. It becomes a homeless camp. We've had to put security fences up, right? So there's another building that's in not a great location. But then I have other buildings that lease up immediately. We don't have any other scenarios. And so we have these cycles that we need to go through. And there's some areas that are going to take a little while to clean up. And the hope is that as those areas are changing, they're not dragging on the other areas. And so
give us, Mike, just to backtrack for a second, give us an example of an area or two that you own something that is leasing up immediately. That
is leasing up immediately.
Yeah.
Southeast is great. So
Yeah.
Southeast is amazing. Yeah, so like I bought Buckman's one of my favorite neighborhoods, Southeast. Bought a property on 18th and Morrison.
29th and Hawthorne.
29th
That's
and
where I
Hawthorne,
live.
guys. Just on 29th and Hawthorne. I've got a project on 24th and Sherman, a 4-unit infill cottage cluster. We've got pre-sales there at our highest prices. Another example is like North Portland isn't great. So North Portland it's more like east of 82nd, where it's more lower incomes. It's supposed to be more blue collar. It's an area where we put the max through. So we've dumped a ton of public capital and they became trendy, and you have some nice buildings and you have some good pockets of higher income earners, but North Portland's been overdeveloped. And then you combine that with, it does have lower incomes, like those zip codes compared to inner Southeast, the income ratios are different. And so it's harder to sell in North Portland. You're not getting the prices that you're getting. You have longer marketing times. And so what we're really starting to see is we actually have cycles. It's interesting, where we didn't have that when capital was rampant. We had too much money at a really low cost. People don't make decisions because money isn't real, right? It's like, oh, well, we'll offer 50 grand more because it's 40 grand more, 40 bucks more a month. Well, 50 grand more now is 80 bucks more a month when we're already tapped out. So the decision process is different, and that is showing up in the scenarios. So all in all, the market is operable, I would say that, but it is slow. I mean, we have, historically low amount of sales volume.
What about Terwilliger? Definitely asking for no particular reason
You don't
at
have
all.
a property in escrow in Southwest Terwilliger. So I'm not a fan of Southwest
Yeah.
Portland for apartments, and the reason being is our property tax code's a little messed up. So like your property taxes for that Southwest Terwilliger property are probably similar to my 8-unit on Northeast Stanton.
Mm-hmm.
Just because it's the way our property tax code works.
But so you just underwrite it, right? It's just a line item. You just put it in your numbers, right?
Yeah, but to get the prices, when you actually when you correlate those two things, what amounts to in price, not many. Like I don't know. I've just never had success buying stuff on the west side.
No, fair enough.
Yeah.
Cool. Hey, so
I do want to talk about getting in front of capital though, because you
please do.
Really good. So my anecdotal experience was the first time I bought land that was. So background, I've built a 4-unit apartment, like I built a 4-plex that I've kept, and I've built a lot of middle housing, 52 condo units over the past few years that have been built to sell projects. So I've done it, and I built spec homes and sold those prior to that. In 2014, 15, 16, right around that period of time is when we got an escrow to buy our first piece of land. I think we paid like $600 grand for something we could build a 22-unit apartment building on. Multnomah Village, West Side. Great lot. It was a slope. But anyways, so this was a period of time, I think it was 2016, 17 when we were really ramping up. This was when institutional capital was starting to flow into Portland. And so I remember, oh man, I want to build apartments. I want to do this. And it was so hard to get any momentum because it was already here. I remember, like competing with Kevin Kavanaugh in a living room with a seller who idolizes Kevin Kavanaugh, and then competing with him on a project where...
Who's Kevin Kavanaugh, real quick?
He built the Fairhill dumbbell. He's built the building with all the tree pots on the side of it. He built the zipper. He's built the coolest. He's my favorite commercial developer in Portland. So he's done a couple of TED Talks. So I remember talking, this was 15, this property owner. I'm fighting with Kevin Kavanaugh over this piece of property. We're both fighting with each other, knowing that we're offering too much money. Like, I think I wanted to offer no more than 100. Trying to beg him to accept $1 million. I think Kevin offered 1.2, and then not even an institutional investor, another local guy with just deeper pockets came in and bought it for 1.4. And then he built the project out and sold it to institutional capital. So you just couldn't buy projects because you were competing with this flow of capital. You couldn't get contracts from the builders because there were so many projects going on, and they were building out to people with $100 million store of capital, right? Like trying to get a project out of the ground was almost impossible for a guy like me because I didn't have the track record, I didn't have the momentum, I didn't have the background, and you're competing with guys that do. It is completely different right now. So for example, like one of my brokers just bought a piece of land, commercial land on MLK. The county's got it valued at $1 million. You probably could have put it on the market and sold it for over, like $1.2 million 5 years ago. I bought a piece of land a similar size across the street in 2015 for 600, sold it for $1 million 6 months later. We're talking 10 blocks away, same street, 10 blocks away. That property, who I sold it to, that developer died, or they went to bankruptcy. The project ultimately failed. Someone brought that lot for over $1 million, entitled it, and then sold it for $2.7 million last year to a low-income housing developer, right? So they just bought the lot, entitled it, got a capital stack, a low housing capital stack, and then sold it for $2.7 million. So that land that was valued at $1 million, my broker just bought it for $350 cash.
Oh my God.
Yeah. And the only reason you can do that is because no one is buying. So he's afraid of death. I'm like, just buy it. You'll make money. You're either going to make short-term cash, or, if you have the balls, you will entitle it. You'll partner with someone, get a LIHTC capital stack approved, and you'll make $1 million just donating it to a partnership.
Mm-hmm.
He's put it on the market at $625,000 listed on the market, crickets. No one is even calling. So it's just, that's where we're at in the cycle, whereas capital is not flowing. So it creates a huge opportunity. And that's what I wanted to get into for you. And right now, because I felt what it was like having no momentum, not having the balance sheet, not having the track record, trying to compete against a bunch of people, we're looking at now, you don't have to have a balance sheet. You don't have to have a track record. You have a little bit of private capital. You have a little bit of guts. You can go start buying product. In case in point, I walked a building. A property came up recently, and one of the big shot brokers in town. We made an offer immediately. They sat on it. They made us go walk the property. I drove all the way from Salem to Portland to go walk one unit. It was a waste of freaking time. They don't have any offers. The doom report came out the day we toured the building. It's been another weekend. So now they are earnestly negotiating with us because they simply don't have anyone else to negotiate with. And it was an aggressive seller financing offer. So you look at it in a 1% rule on the market at scale, seller financing. We're negotiating around the 1% rule, and rents are like 30% below market.
I'm having a similar story too. We had somebody kind of disappear on our offer, and then they sat there and they go, "Oh wait, I think this might be the only guy who's interested in it." Now they're kind of re-engaging with us. So it's
So we like to do creative offers, right? I made one a while back, and I thought I had a verbal acceptance. I sent them over, and I thought we're going. This is going to happen. Sent them over an actual purchase agreement, and then they went dark. And then a couple days later came up. They decided to sign a listing agreement, which is really funny because they signed a listing agreement with the broker that I was walking. So I got an email back from them the day I was going to go walk that other property with the same broker on both properties. And they're like, "Hey, I feel really bad." And kudos to this owner to email me back, right? A lot of owners don't do this, but tail between their legs, I apologize. Your offer, I knew it was a good offer, looking that it was by far the best. Would you still consider it, but would you work with this broker? And, so that's just kind of the reality of what we in, and that's just a lack of demand. And it's not lack of demand because people don't want to own real estate in our vicinity. It's lack of demand because money is puckered.
Right.
So you need to understand those two differences. Are we in a economic doom loop, or is money just puckered and this is a cycle?
Gotcha. So where for people listening, or just talk about your business. I mean, you sort of got into it there, but where specifically are you seeing opportunities that you're trying to capitalize on right here and right now?
Because of my appraisal background, I understand the importance of land, and the importance of land meaning that changes the value the most. And the reason that changes the value the most is because investment capital, especially in the development world, is like a spigot. It turns on, it turns off. In the housing world, it doesn't ever turn off. It just turns down and it turns way up as far as people buying houses.
You mean housing for
the end buyer,
personal residences?
Right? So, yeah, the 1 to 4 unit world, the spigot never actually turns off. People always need to move because that is shelter component. They're living in it for the most part, even in the 2 to 4 unit world. Especially important, a lot of those buyers live in one of those units. And so the financing is residential, it's owner-occupied type financing. That spigot will slow down, but it never turns off.
Mm-hmm.
When you get into commercial financing, that spigot will just literally turn off. And so you look at the different types of commercial assets then. Well, you can have income producing assets, even though those properties, apartment buildings, for example, office buildings, even more, even though they have income, the capital stream is still going to turn off just because of the nature of lending. We get concerned, you pull back on it. And so that's what we're seeing. Like the reason commercial real estate is distressed right now in a lot of asset classes is not because those assets are not performing. It's just because they're at the end of the maturity date and they can't afford the new cost of debt based on their
that's what I always hear from people. They talk about 08, 09, or when the people that blew up with commercial real estate. It's almost the stories I hear. It's almost, and I wasn't around back then. I wasn't investing. But the stories I hear are almost never like the asset isn't performing. It's always debt maturing at the wrong time and not being able to get new debt on the property. It's mistiming. Your maturity date just arrives at the wrong time, and all your numbers still look good. Your DSCR coverage is good. You have. You don't have bad vacancy, all the stuff's in place, but people just still won't lend on it.
Yeah. And so if you've got, and I'll just give you like anecdotal evidence with us, right? So, July 2022, August 2022, that's when it became really freaking obvious. This wasn't a blip. This is a trend, which is going to be a cycle, and this is going to be a period of time that we're in higher for longer, right? So we started talking about higher for longer in July, August of 2022, and we started re-looking at our entire development pipeline. And we're into all these development loans, right? So we're buying projects, we're permitting them and entitling them, so we're getting them in acquisition and development land. You entitle them, and then roll them into construction loans. And for us, we had a rental portfolio. We had assets that we could liquidate. We had a lot of capital stacks that we could show lenders. And so there's this period of time where we had 6 or 7 projects that were in technical default, meaning we made all the payments. We are moving the project forward. We're getting entitlement, but the maturity date came and gone, and we weren't at a point. We didn't have anything we could sell. But we also didn't have anything we could borrow. Like we didn't have permits. We couldn't get that new next stage of construction lending.
What do you do when that happens? Do you just keep paying them, or?
Yeah, well, they don't allow you to pay them. So that's the problem. Is once you go past the maturity date, servicer turns off the collect. You can't actually pay them.
Yeah,
and so you have to then pull it out of default. So either extend it. So we worked with a lot of extensions. We rolled into construction loans. So some we paid off via construction loans. Some we got extensions, and we had existing assets, and we could sell those. So you just develop this plan of, okay, what is the liquidity necessary to get through this pipeline? And then you start really running these numbers of, hey, what does this look like? And the most alarming part of that was when we were buying real estate, and so even background is 2020 and 2021 is when we got pretty aggressive into buying middle income housing projects. So stuff you could single family zoning where you could do duplexes, triplexes, fourplexes, and cottages. And so we bought a handful of these different properties. The first waves were single families and ADUs. Then we had a wave of fourplexes, and now we're kind of on the wave of cottage clusters. And that's designed based on how the code was implemented and the type of projects we're buying and the timeline to entitle these. And so in all, as those, where am I? Anyway, so we're entitling all these things. We're putting all the money into that. And as we were buying this land, lending parameters at that time were 90% loan to cost, 70% loan to value. So you only needed 10% of the capital requirement and the cost of interest to do these projects. In July and August, lending went down to 70% loan to cost, rates got more expensive, points got more expensive. And so essentially what the lenders are saying is, we're done. We see risk, we're exposed to risk. Immediately we're changing our lending parameters to reduce our risk exposure. Which makes sense because they want to get their loans back. They don't want to loan. So what they're saying is, we are now narrowed our buyer pool, our lending pool. We used to lend to this amount of people in the marketplace. Now we're lending to this amount of people. So if that were me 10 years prior, I wouldn't have had the balance sheet to get through it. The market conditions simply weren't there. Wouldn't have had the liquidity to get through it. So, man, so what am I trying to answer? How do you get through that process? So then you just start looking at, well, what are the market conditions like? And you start making decisions, which is, we can plow through, for the next 2 years and get through these projects and try and make hopefully a few $100,000, or we can just let it go now, right? You literally have to make that decision of, do you plow through? Can you paint a picture of how long is it going to take to get through this? What are values going to be at the end?
Let it go now, as in just hand it back to the bank.
Yeah, correct. Yeah. Right. Like, those are the options. And what we did in 2022 is we just modeled it all ahead. And now we're 2.5 years after that, early 2025. And, I can look back at that decision and go, dude, it's been a hell of a lot of work. And I've taken out loans on rental portfolios to add liquidity. And I've worked with private lenders to move from project to project to create equity to get these things built. And at the end, we're at the end of the pipeline now. And was it worth it? Absolutely, because I have a track record, an untarnished track record that I can now go leverage into the future. But not everyone has that mindset. Was it worth the effort as far as how much money was made? Absolutely not. Absolutely not.
People don't think big picture like that. Most people don't. They think about what's happening tomorrow, what's happening next month. They're not thinking about what's my track record and what's my reputation going to be in 3, 5, 10 years. That's just not how humans work.
Yeah, I was driving today and I was literally thinking, I was like, would it have been best in 2022 just to pull the plug on everything and then just focus on raising new capital and doing new projects to make my private lenders whole in the end? That's my daughter calling. Let me... I don't know. We probably could have made more money. I probably could have made my lenders whole sooner. But, my lenders are happy because they still got interest that whole period of time. They're all paid off.
So let's talk about...
That's the decision you have to make. And so where are the opportunities then is I'm still focused in that part of the arena because, I've gotten so much experience through that. I've got all the knowledge that I need, kept all those lenders intact, right? So I didn't tarnish any of those. Not only did I not tarnish my reputation, but all of those lenders are now like, Mike, you're the man. Let us lend you money. And so they want to do our projects. But the main reason I'm really all in on that, still on that segment, is because my competition's gone.
Mm-hmm.
And I've had, you talk to the people that were buying land for that in 2020, 2021. You talk to the builders that are still here now, still building product, and the builders that are still actually looking for more. We're excited. you talk to, and I'm specifically talking middle income housing, you talk to the brokers, none of them know what the value's worth. Wholesalers have no clue what the value's worth. So it's like this really long, slow dance you have to do with property owners, which is, hey, I'm going to be open and honest with you. Here's everything you need to know, an hour conversation to get you the background of like, this is why my offer is this, and this is why it looks really, really low. So you can talk to all these other brokers, and you can talk to these wholesalers, and you can go down that road. But the reality is you're going to be back here talking to me or one of my friends in close proximity to the price I'm giving you. Because that's just the reality is those other people can't get the deal done because they ultimately need someone who's going to fund the project.
Right.
Does that make sense? And so I love land right now because land crashes the hardest. And it crashes the hardest because that's where the spigot turns off the most. And the capital spigot turns off the most because it's the longest timeline. It has the most risk. And so that's where it stops the most. And so I love going that direction.
Talking about the spigot, give me so in 2020, 2021, we were at a 10 on the spigot, I would say. Where are we on a 1 to 10 right now, would you say?
We're not a 1.
No,
we're not
no,
a 2. You know, and I remember my first seller finance deal, 2012, was a land purchase. 28th in Alberta. You know, amazing location. $110,000. $110,000, 0 down, second position seller finance.
Jeez.
Behind a construction loan. Because that's 1 out of 10. Because there was no capital. And it was land.
Well, that's what's cool about these. I mean, you've touched on this. That's what's cool about these market conditions. It's like, okay, a few years ago, sure, it's fun. Everybody's printing money, but sellers aren't going to have any tolerance for you come to somebody with creative terms or, you know, whatever it may be to help you get the deal done. They're going to go, yeah, cool. I'm going to go to the next guy or gal who isn't asking for any of this because everybody's a buyer in those conditions. So it's, in some ways it's not as much fun as back when rates were 3% and you could just rinse, repeat deals, refinance and do that whole dance. But in some ways it's, you know, if you're a savvy investor, there are huge advantages to this place in the cycle. Yeah.
And, you know, maybe and that's why sub 2 makes a lot of sense, right? Like sub 2 is not a great business. It's not a business model. It's a tool. People turn it into a business model because it works really, really well right now.
Because Pace Morby turned it into a brand. That's why everybody knows it.
I remember talking to Tarl Yarber at Limitless. I think it was 2021. I think it was 2021. So the market hadn't turned yet. Maybe it's 2022. And Pace had spoke at that conference. Tarl put him on stage and Tarl was like, Pace is going to kill it. And I was like, yeah, because market conditions that is exactly what is going to. Now, will that happen into the future? It's a direct inverse correlation relationship to your ability to turn your house into cash. You know, when inventory is under 2 months, you can turn your house to cash in 30 days. You do not do anything creative. When you cannot turn your property to cash at all, to the amount of cash you need to pay off your loan, you'll be creative all day.
Dude, I see it right now. I have one where I'm offering creative terms on it because for that exact reason. I'm like, I want to get liquid on this thing more quickly, and that's what the conditions are right now. But like you said, it's all this stuff is just like you said. It's not a business model. It's just a tool to have in your tool belt that you can use when it makes sense.
Mm-hmm. And it's, you know, we portfolioed some properties over the past few years. And so anything that I bought from 2022 on that's been portfolioed and refinanced into a DSCR loan, those properties suck. The reason being is they have the lowest return on equity. Their DSCR is like right around 1, if not under 1. So they don't add anything to the global DSCR. In fact, they drag on my real estate schedule from a global DSCR. Terrible return on equity. They have prepayment penalties, so you can't sell them. They're maxed out from a cash flow standpoint because they are 1.0 DSCR, so you can't put a seller second behind it. Mm-hmm. But on the other side is you look at them as like the basis, what we bought them at, and our yield on cost. They're the best projects we bought. But I mean,
Right.
right. So that's the weird. So right now you can portfolio stuff, and the only way to portfolio stuff is to get one of your best cost bases you have in your portfolio. So technically, what you're saying is from a
When you say,
macro.
Mike, when you explain what you mean when you say portfolio stuff.
You put it in your rental portfolio, you're going to hold it. So I'm not buying
Okay.
it to sell it. I'm buying it to hold it as a rental, right? And so your ability to cash flow is just related to your basis, right? How much equity do you have in it? What'd you buy it at? What's it worth? Whether you put cash in it or pull cash out, what's your equity? That's how you're making your money. So, but when rates are how high they are, we have more equity. And the reason we have more equity is because we need more equity to get a lower loan to value ratio so that we can get a 1.0 DSCR. So when rates were lower, you could be at a 7% loan to value ratio and have a 1.2 DSCR, a debt coverage ratio. What we're finding now is you need to have 65 or 35 to 40% equity. Your LTV needs to be in the 60 to 65% range
Right.
just to get a 1.0 debt coverage
Yep.
ratio, just so you can get a loan. So you can get the loan, but the loan sucks, because not only because of the interest rate, and I'm not saying it sucks because of the interest rate. I don't care about the interest rate. It sucks because it's a 1.0 debt coverage ratio, which means there's no cash flow.
Yeah.
So you're literally just portfolioing stuff just to portfolio it. It doesn't provide cash flow. Lenders actually don't like it on your real estate schedule because it actually drags. They want a 1.2. And so they see that and they see it as a problem, not a benefit. And then it has a prepayment penalty. So you're not going to sell it to then go liquidate that equity. So it's this weird period of time where you can get a great basis. You can be really happy about these properties that you buy, but for the next 3 years, they don't help you.
Right. So, high level question for you, Mike. Before we'll try to get you out of here soon. I know your daughter was just calling. So you've been in the game 20 years. You talk about having the example you just used with your lenders, like keeping that reputation, keeping that track record intact. You're a guy, like, if you ask around the industry, there's not anybody that has anything negative to say about you, and you and your company have a really good reputation. By the way, company Rare Bird, will put them in the show notes. But for people who are, I mean, I'm not a new guy, but I'm 5 years in. People that are starting out, I mean, other than the basics, like, don't screw people over. But, like, how do you? What would you tell people about building a reputation like that not only makes, that people just say, oh, he's a good guy, but also makes lenders, other investors, brokers, etc., makes people excited to work with you, and ultimately brings deals your way based on your reputation rather than brings in inbound leads, I guess we would say, as opposed to having to, like a lot of us, having to chase stuff down.
Yeah. One is just longevity. So I've been around for decades. And so I've just put a lot of free education and mentorship into the community over a long, long period of time. But the main thing is I look at it as an infinite mindset. I don't look at it as a pie and I'm trying to get as much of the pie as I can. I look at it as, hey, there's a pie. Can we have fun eating this pie together? And if so, let's do a deal. If especially in our world in the off-market real estate, people are notorious for trying to get $2,000 here or $3,000 there, or like be shady as fuck to get $5,000 here. I will never sacrifice anything in my future to make this one little deal better. Or, you know what, the only way to get this deal is if I do some shady shit, so I'm going to do some shady shit so I can get this deal. I'm not going to sleep it well at night, and so I'm not going to do that. And then over a long period of time, that just turns into a reputation that people trust me, right? And so, working with new people who are trying to get into it, and they're told in the education, you can't tell addresses, you can't tell. It's just, when I work with new people, it's like, look, I'm not in a position. People tell me addresses all the time. I'm not in the position I am because I go and take your deal. I'm in the
Right.
position I'm in because I'm either going to add value to you, and you're going to go get that deal done, and we'll find another way to do a deal, or I'm going to look at it, show it a different way, and I'm going to tell you I can buy it, and we're going to do a deal together. But the last thing that's ever going to happen is, oh, hey, Mr. Seller, this person told me about your property. They don't actually know how to buy it, so I'm calling you so I can buy it directly. you're always tempted to. Like I'm dealing with something right now that's stupid. It's a broker, licensed broker. It's a a 10 to 15 unit ish. And I just got another text. So I freaking had to do everything, send an NDA just to get the worst freaking financials on this property. They wanted a POF for $2 million. That was their stance. Send me a POF for $2 million. And I'm like, you send me something, I'll make a decision on whether it's worth my time to put together a POF. And then I did finally get them to send over the NDA. The income stuff is complete bullshit. And just on this phone call, I got a text. Hey, you interested in this property over? And it's like, that's my fucking deal. And I know that guy has not a dime to his name, right? So this is the daisy chain of bullshit that you get into in the off-market world, where it's like, I know who now that I've seen those financials, I know who the property manager is. And I know that property manager is a licensed realtor. So I know that this person who is a licensed realtor is actually trying to they don't know. And I keep asking, are you wholesaling it or do you have a listing agreement? Oh, I don't know. We haven't made that decision yet. Right? Which tells me that you don't know if you can wholesale it or not. You don't know if you can you probably have a contract on it, but you don't know if you can wholesale it. You probably can't get a list, right? So I am tempted to just go talk to that property owner who I was on the rental services commission with, which I have a relationship with, and just say, hey, dude, this guy's trying to do some shady shit behind your back. But I get no value in that. Like, what's that for me?
People are so simple, man. It doesn't, like, you can understand humans really quickly by just understanding, like, fear and greed explains everybody. And greed does not have to be, you touched on it. It doesn't have to be that much money. The shit I see people do, you see people do for $1,500, for $3,000, like, it does not need to be big numbers. Mm-hmm. And you touched on it. Like, it's, aside from just being the right thing to do and being able to sleep at night and all that, it's actually, it's long-term profitable. It's long-term greedy, honestly. Mm-hmm. Like, your reputation is going to be worth, if you do things the right way, that's worth millions of dollars down the line, but no one thinks about that. It's literally, where is the next bag of money coming from? And I don't care what I have to do to get it.
Yep. And we see a lot of those people out there.
Yeah. So, hey, what last question? Or actually, I have two more. Well, the last one will just be where people can follow you. So, one thing you touched on, and I know you do a ton of, between, you speak at the Salem meetup, you have your investor lab up in Portland, but also you just take calls with people. You give away a lot of free knowledge, which you mentioned a minute ago, and that's myself included. Like, you'll take my calls, and you've helped me with a lot of stuff. I remember when I was starting out, you always hear on podcasts this idea, like, if you're going to go talk to somebody who's further along than you, like, you need to bring value to their business. You need to offer them something. You need to, you got to bring some sort of value. And I remember, actually, when I was starting out, I met with Gabe, and he didn't do any of it. He was just like, I just like talking with young guys who are, I was like, I just started. I mean, what is it? Do you just like doing it? Do you think it's good karma? Why do you give away so much knowledge? It seems, from where I'm standing, to just about anybody who comes to you.
Yeah, I mean, I think everyone wants to, like, give. Mentorship is kind of a DNA fulfilling purpose. So there's value in that. Just there's a reward. There's a reward, right? So my favorite quote is the Zig Ziglar quote. You help enough other people get everything they want in life, you'll get everything you want in life. I butchered the crap out of that, but it's just kind of that thought process. There is a purpose to it. And I'd also say this misnomer about bringing value. You don't need to bring value. You need to bring energy, and because you don't know what most people don't know what they can bring. And so the question you ask, which you don't ever want to ask, is how can I add value to you? Because immediately now you get the person thinking in a way you don't want them thinking. No,
you probably can't.
Yeah, you can't, because you don't know yet, right? And so bringing value to someone is a process. And the way to bring value to someone is, you have to find out, how can you bring value? So typically that means with a meeting. So you want to meet with them and you want to be excited. So your first value that you bring is, guys like me just want to have fun. And so we just want to see excited people. And so a young real estate investor it's awesome because they have the entire spectrum. They have complete ignorance and naivety to what it is that they're getting into. They don't know how to value anything. They think they have to do this one process. Like they're so raw.
Whatever
But
the
at the
last
other,
podcast they listened to was, whatever strategy was talked about
exactly,
on that one.
arbitrage and Airbnb, whatever it is,
Yeah.
right? But at the same time, they also bring this level of excitement that you don't
Yeah.
always see, and so what you don't want to do is come bring a level of excitement and then stay 100% and never talk to them again. So I actually don't talk to as many people as you think I do. I used to do it more, but then you get to a point where people just kind of stop reaching out to you. And then I have a lot of delegation built into my systems now. So it becomes less and less. But I've had so many people reach out, go to lunch. Like I've had so many wasted lunches where no one ever followed up. But I'll give you an example of Jude. Jude is a really great example of a new kid who's coming in. He's excited. He's met with me. I've given him some value. Then he just goes and takes action on what I said. So you go meet with someone. They're going to give you some advice.
Sorry, plugging in charger.
Yeah, no, you're good.
Keep going.
So the worst thing you can do is meet with someone, get really excited about it, miss the little buckets of actionable advice that you can take action on, and then not take action on it. The best thing you can do is take action on that and then report back. So what Jude does is he learns, okay, boom, that's the action step. Great. I'm going to go take that action. And then 2 or 3 months down the road, I hear back from him. Based on taking that action, he now has the next question.
Yeah, exactly.
Step, right. And as you're taking action, what happens when you're taking action is you're creating opportunities that you don't have the skills to take down. So as we're going down that arena, it's like, hey, Mike, I got this deal that are you interested in this? Are you interested in that? Right. And so then immediately within a few action steps, now you're adding value to each other. Right. Because now he's got opportunities that I'm looking at that I could potentially buy. So it's, oh, great. Now I'm looking forward to Jude's phone call because he's selfish. He's going to ask for something that he needs to know. And I'll be happy to give them information because he'll become a better person. And one day he's going to pay it forward to someone else. And he's going to be paying it forward. He's like, yeah, this guy, Mike Nuss and Gabe Johansson, they helped me out. And so I'm going to help you out. Right. So you're just putting that into the atmosphere and it's coming back. And it comes back faster than you realize. And it's typically in the form of a deal because that's the easiest way for you to truly help them is being a resource that they can drop deals to, is being a resource to them that they can provide to someone else. And that's just the networking effect. And that's the magnet effect. Right. And so the more that you do that, the more you get feedback. And when you get feedback from the industry of who you are, how you quickly know I shouldn't be doing this. Feedback from yourself at how you sleep at night. Yeah, I shouldn't be doing that, right? And so it all kind of just starts with taking action, following up with that action, but then reporting back. So don't be a hermit. Don't be an ostrich. Like you need to communicate with the people in your community.
Right. Yeah. I'm the last year or two, I'm at the point where I do have people reaching out and that's it. Like taking action is the thing. Like, I don't want to talk to you. That's what I tell people at the end of every call. Like, don't overanalyze this, go, you don't need business cards. You don't need a website. You don't need a AI thing that you built. You need a deal and you need money. So go figure out where you're going to get the money from and go figure out where you're going to get the deal from. And then you can figure out all that other shit later. But that's it. Yeah. It's all about, taking action in this business. I mean, I know people that have been telling me they're buying their first deal. They were telling me about it 5 years ago. They'll be telling me about it 5 years from now. And that's, I think, what makes people not want to give away, what you were talking about, give away knowledge, is when you get stuck in that phase where you're kind of not doing anything with it.
Yeah. And then there's layers and levels to it. So what I'm really excited about in life now is where ever since joining GoBundance, I got a lot more bold and
which you got me into. Thank you.
Yeah, my pleasure. So I'm pretty real with people now. Like I'll call them out because our words give things away and our actions as well. So, a good friend of mine, he takes a lot of action in life. He has a lot of success. But I was meeting with him this summer and he said, I'm doing this, I'm doing that. I can't. He was complaining about not having enough deal volume, and at that, first I was mad because I was supposed to meet with another friend and he was at that. He just hijacked the entire meeting. And so the meeting I was supposed to have, I didn't get to have. But he's complaining and I look at him like, no, you're not. Because if you were really doing what you were telling me, your results would be different. So are you really taking the level of action that you say you are? Or are you just saying that that's your level of action? I wouldn't have said that to someone 5 years ago. I just said this to a best friend, someone who actually has lent me money, right? Like, no, you're not. You're lying to yourself and you're lying to me. And so if you want to have the success and the track record that you say you want to have, you actually need to follow through with what you're saying. Dude, that bothered me for weeks that I had said that to him because we didn't communicate for a while. And then 2 or 3 times since then, he's reached back out. I was like, hey, man, thanks for saying that. And since then I think he's bought 4 or 5 properties since then. And now he's like drowning in other types of problems because he's taken too much action and has too many things going on. So on the mentors, for mentors out there, like it is okay to just tell people that they're not doing a good job.
Yeah. I mean, we could do a whole another episode about GoAbundance, but that's the main reason I joined. I mean, it's good friends or people that care about you you don't want to surround yourself with yes men or yes women. You want people that'll call you out on your shit. Okay, Mike, before we let you go, wait, here's a quick yes or no question. Are we going to buy that? Are we buying that Salem deal together in the next 12 months? Yes or no?
I don't know if he'll be desperate enough in 12 months.
I know. I was hoping you'd give me some fake. I
will say this: I'm really glad he didn't accept our offer, just because the conditions have just gotten more exacerbated. It just would have been that deal if we were trying to like refinance that. It just would have been problematic.
It's a little shiny object. Let's wait for I think he's going out to every wholesaler on the planet right now to try to get what he wants, and he's not getting it. So he'll come back to us.
It's a double-edged sword being creative. So if you think about it, if you're just trying to get more and more creative, you're trying to find ways to work harder to pay more for the property. And at some point you work to the point like, look, I've worked as hard as I'm going to work to pay more for the property just to reward you. So when they come back, now you've got this feeling of, well, I don't even want to do the deal anymore. And so the only way for me to want to do the deal is if we make it better. And so then you have that kind of dance when you get back into communication.
Yep. The guy that wins the negotiation is the guy who doesn't really want it that much.
Absolutely.
So good lesson.
You have to have deal volume. You have to have deal flow so you don't buy bad deals.
Because the desperation creeps in, even if you try not to, you can't fake it. It's just always there. So, Mike, before we let you go, I of course shouted out the Deal Junkies podcast, which is my favorite real estate podcast out right now. You guys are crushing it there. But anything else you want to plug? Your business, your meetup, whatever. The floor is yours.
Yeah, I mean, anyone in the Salem reporting area, Investor Lab, come to the Investor Lab meetings. They're fun. Just fun to hang out. If you're cool, give me a call. Buying deals in Portland and in the Valley as well for apartments, income property. So, yeah.
There you got it. All righty, Mike. Well, I appreciate your time, my man. Have a good one, and thanks for joining us on the
thanks for having me.
Saucetown Investor.